Hi, this is Prasheel coming to you from Mumbai, and you're listening to the Equity Master Stock Market Wrap Up. In today's edition, I'll be taking you through what moved the markets over the week. So let's jump right in. The government's PSB recapitalization plan. Is it a good idea? The US Fed raises interest rates again. How does it affect you? The rupee recovers as oil falls. Now, a quick look at the broader markets. Asian and European share markets were trading in red following negative cues in the US markets post the US Fed rate hike decision. Back home, Indian indices plunged at the end of the week amid a difficult global scenario. With the markets out of the way, let's look at the key stories in focus today. The government plans to infuse an additional 410 billion rupees into public sector banks. Now, this will take the total amount of bank recapitalization at rupees 1.1 trillion in the current financial year. While the government has already infused 230 billion rupees into PSBs this year, the remaining 830 billion will be provided in the remaining 3 months of FY19. Reportedly, the Department of Financial Services sought Parliament's approval for grants for additional funds over and above the budget estimate of 650 billion rupees for bank recapitalization. Earlier this year, the government pumped in 113 billion into 5 public sector banks, including PNB, Allahabad Bank, Indian Overseas Bank, Andhra Bank and Corporation Bank to improve their financial health. However, using recapitalization bonds can only act as a short-term measure to the crisis affecting Indian public sector banks today. Such a measure will not address the structural issue in banking system, that is the poor standard of lending and poor governance systems. Our big picture editor Vivek Kaul talks about the moral hazard risk arising out of recapitalization. He writes, "If the government bails them out this time around, the banks know that they can count on the government bailing them out the next time around as well. And this means that they can follow fairly loose standards of lending in order to lend money quickly." Vivek's article on bank recapitalization is worth the read. I urge you to do so if you haven't already. Moving on to news from the global financial markets, the US Federal Reserve raised interest rates as expected, but forecast fewer rate hikes next year. The Fed noted that some further gradual rate hikes would be needed and a subtle change that suggested it was preparing to stop raising borrowing costs. The Fed also said that the US economy has been growing at a strong rate and the job market has continued to improve. The rate hike, the fourth of 2018, lifted the target range for the Fed's benchmark overnight lending rate by a quarter percentage point to the range of 2.25 to 2.5%. The decision to raise borrowing costs is likely to anger US President Donald Trump, who has repeatedly attacked the central bank's tightening this year as damaging to the economy. Now, how does a US interest rate hike affect you? The instant effect is foreign money moving out of India's vaults. This means a slight correction in the share markets in India, albeit temporarily. While this might prove to be a good buying opportunity in long-term stocks, the main thing to look forward to would be capex and earnings trends. In the end, Indian investors are better off staying informed about corporate earnings revival rather than Fed rate hikes. Moving on, the Indian rupee witnessed good gains against the dollar this week. Earlier this week, the domestic currency rallied by 112 paisa in a single day and marked its best single-day gains in over 5 years. The rally came on the back of softening crude oil prices, which eased concerns over India's current account deficit expansion. Besides, the American currency's weakness against its major rivals globally helped the rupee further its gains. Notably, oil prices have dropped over 10% in the last 1 month. Prices remain under pressure on concerns about future oil demand amid weakening global economic growth and doubts over the impact of planned production cuts led by the OPEC countries. Notably, US crude oil and Brent have lost more than 30% from early October amid swelling global inventories. Meanwhile, for the first time, oil production from 7 major US shale basins is expected to climb to 8 million barrels per day by the end of the year. Supply cuts agreed by OPEC and its Russia-led allies might not bring in the desired results as US output goes on increasing. These cuts are also coming from currently high production. Oil output from Russia has been at a record high of 11.2 million barrels per day so far in December. It will be interesting to see where oil goes from here. Well, that's all from us today. Before signing off, we would like to know if you like our podcast. Is there anything specific you want us to cover? We would love your feedback. Just visit equitymaster.com and drop us a line. We look forward to hearing from you. Thank you and happy investing.